of Horizon Investments. He joins us from Charlotte, North Carolina. Scott, thanks a lot for joining us. You say in some recent commentary that when you get your hands on the so-called dot plot projections today, you'll be more interested in the longer range view that those dot plots express rather than what lies ahead in 2025. Why?
Hey, Paul, thanks for having me. Look, pretty simply because the market's already taken out a lot of the cuts projected earlier in 2025. We're down to basically 2 right now, so it's just not a whole lot of room there to do anything very interesting. But the market really is still struggling, and the Fed, frankly, is still struggling with where does this stop? Where's so-called R star? Where's the neutral rate? Where's the Fed ultimately going to stop this cutting policy? And that has undergone quite a lot of revision over the last year or so. We're up about 100 basis points. Over last year, and what the Fed expects that sort of stopping place to be. So if we got further increases in that rate, that's actually going to be probably more impactful for markets as we walk through the next year or so than whatever they're going to do in the next 6 months of 2025. What do you think they're going to do in late January? So I think they probably will, take a pause or take a skip, because this labor market is still relatively resilient, because inflation continues its progress down, albeit both of those things fairly slow. They probably think they have a little bit of time and a little bit of wiggle room to just pause and see where we are. That said, if we do get further or quickening deterioration in labor markets, they won't hesitate to cut again in January. It just right now it looks like labor market is holding up pretty good, and so I think they'll take that, to sort of take the grace that market is giving them and take a pause in January. You think, if I understand correctly, that 2 cuts are coming in 2025, and you note that the market would prefer 3 cuts. How do you think the market responds if it becomes clear that only 2 cuts are likely? Well, to be clear, Paul, right now, 2 cuts is what's in the market, so that's sort of in the price right now. We just think that if they do surprise, if there is additional cuts that are forecasted, if they go to 3 basically in 2025 in the dot plot this afternoon, the equity market will take that as a fairly comforting sign that they're not going to stop too early, that they're committed to getting rates back towards neutral more quickly than more slowly, and that's overall good for sentiment. It's overall good for equity markets. Getting a little bit lower rates a little bit more quickly would overall be good. But I don't think it'd be disastrous if we just got 2, because that's basically what's in the market right now. Okay, as we get to the end of this year, the S&P 500 is up a remarkable 27%. The NASDAQ Composite is up a more remarkable 34%. As we know, this comes on top of big gains in 2003 as well. And one of your views right now is that investors should be getting careful on their U.S. equity market exposure, correct? There are stock markets elsewhere in the world, and you think investors should be cognizant of that fact. Yeah, look, it's been a really nice 2-year run in U.S. equity markets, and we don't, to be clear, I don't think 2025 is going to be a bad year in U.S. markets. But if you look at things like positioning and sentiment for U.S., basically everybody in the world agrees that the U.S. is the place you want to be in equity markets in 2025. That scares us. When everybody agrees on the same thing, that thing doesn't typically come true. And so, you combine that sort of overly bullish, overly U.S.-centric sentiment and positioning with what we know out of Trump, the first Trump administration in 2017. Everybody kind of thought the same thing back then too. If we look back at the forecast for 2016, what people thought about 2017 is you have to be in the U.S., you got to be in small caps, and basically you've been an idiot to invest anywhere else in the world other than the U.S. with Trump coming in. And what we saw out of 2017 was the rest of the world outperformed, and especially emerging markets outperformed. So we just want to be cautious, coming into next year, that we don't repeat the mistakes of last time, and just get on board with what has been a fairly obvious trade for the last year or two. We think this time around warrants a little bit more caution in the U.S. Are there non-U.S. markets that you favor in particular? And do you have any thoughts on how investors get exposure to markets that they don't understand as well as the U.S. market? For instance, there are ETFs out there that will provide you to a large basket of stocks that excludes the United States. Yeah, that's exactly right, Paul. And for people that aren't sort of pros at this, that is clearly the way to be. I mean, there are a few ETFs out there that basically hold all global equities except for the United States. That'd be a reasonable starting place if you just don't want to try to differentiate between Europe and Latin America and Asia and Canada and wherever else. But if you do want to have a little bit more nuanced view, there are some interesting things happening in Europe right now. Their central bank is going to have to cut far faster. Everybody knows that growth in Europe is sort of a disaster, especially in Germany. But that, again, like everybody knows this, it's kind of in the price. The same thing goes for China. There's fairly disastrous demographics and policy implications of things they're doing right now. But everybody knows this, it's kind of in the price. And so it's not going to take a whole lot of surprise to the upside in some of these other markets for you to get pretty outsized gains. Because again, nobody's positioned over there right now. Nobody's positioned in Europe, nobody's positioned in China, nobody's overweight those things right now because they've been losers for a few years now. But it just won't take very much to get those markets really moving. And so we do think the kind of early 25 is be a clever time to start taking a toehold in some of those places that have been often hated for the last few years.
Okay, we're almost out of time, but I know you like the U.S. financials, and within the U.S. financials group, you, if I understand correctly, you particularly like the smaller banks. Perhaps that means regional banks. And part of your thesis here is M&A. I believe I hear you saying that we may see some smaller banks acquired through the course of 2025.
That's exactly right. Look, I mean, everybody knows that Trump is going to have a lighter regulatory touch overall, but in particular and within the financial space. And these larger banks, they need to grow. Organic growth is tough for large money center banks in the United States. And so one of the ways you grow is inorganically. You have to go buy assets, go buy earnings. And we think some of these smaller banks, like while they've really struggled recently with some of the regulatory burdens that have been placed upon them, those larger banks have those structures in place to be able to take care of that. And we think that makes for some attractive M&A targets.
Scott, thank you very much for joining us. That's Scott Ladner. He is the Chief Investment Officer at Horizon Investments. He joined us from